Matt, for the introduction. It's great to be here. Myself and Mike, as Matt says, meeting with Matt and James and the team every month to talk about treasury risk management. And one of the words you'll hear us say during the presentation is proactive management, because we don't know when risks will move around, and case in point in terms of the world that we live in today. We're proposing to talk for, we've got 30 minutes. Thought we'd sort of do the presentations 20 minutes and then take questions after the presentation, if you're happy with that.
Yep, and if we go slightly over time, we go slightly over time. We only see you once a year.
Yep.
So it's worth, if you've got questions, it's not your one real chance to do it face to face.
Very good. Shall I control the slides? Is that? Yes. So what we want to talk about firstly is the Treasury policy framework that you manage your Treasury risks to as council, that you naturally accrue through the business of council. And the Treasury policy framework is very much articulated in the Act, the Government Act, in terms of what you need to have in terms of the governance document for you as council. So when we talk about the Treasury risk management policy, we're also talking about the liability management policy and the investment policy, which the Act sort of talks to. Then we'll talk about Treasury management strategy. So how do we implement the policy, given the unique risks that council has got? And then we'll do a financial markets update, and then we'll sum up and take questions. So I was going to kick off, and then Mike was going to present from the interest rate risk management piece and the financial markets piece. In terms of, some of you may have seen this chart before, and it sort of stood the test of time. And I think what is important about this slide, it sort of captures all the unique Treasury risks you have as council, and it puts a framework around those risks. And policy as delegated to management will implement the policy as approved by council. So in the middle there, I put prudent financial management, and the sort of Act talks about stewardship. It talks about the intergenerational qualities of council's business, particularly around managing financial market and treasury risks, not only for the current ratepayer base but also the future ratepayer base. So the policy is constructed around that. First and foremost, the delegations. Only council can approve or amend the policy, and that typically happens every 3 years in alignment with the LTP. I think we're in the stage where we're going to be reviewing the policy, and I think, was it June? Matt, you'll probably get the policy with adjustments coming through at that stage. But delegations, the policy outlines the tasks and the responsibilities of management in terms of implementing the policy, talks clearly about liquidity management and debt management, having enough cash or availability to access cash to pay your bills and liabilities on time, and then long-term debt financing of the balance sheet. How do we manage ourselves in terms of council's long-term borrowing requirements? And also there's always a liquidity buffer, and that's required from your financial covenants that are set out with the local government funding agency, in which council borrows from, and essentially all the sector borrows from the local government funding agency, or the LGFA. So liquidity and debt funding sort of captures that risk in that section of the policy. Then we move to interest rate risk management. So that's wholesale interest rate risk management. So again, being tied into the key objectives of the policy, a prudent financial manager trying to minimise those costs across council's business and protect council for the volatility and movement in those underlying risks. Interest rate risk management, we talk about investments, and that's particularly around there are equity investments, of course, the policy talks about, but from a treasury perspective, what do we do with our cash that we have on hand? How do we invest it? How do we manage it? So again, it's liquid and available to pay our bills on time. Operational risk management, ensuring that when we do our treasury transactions and activities, we do it within an environment of compliance and control. Certainly it's important for those stakeholders that are looking over our business, not only sort of ratepayers, but our lenders, being the LGFA, and also our credit rating agency, Standard and Poor's. And then counterparty risk management. So when we invest that money or we transact long-dated financial instruments, we want to do those transactions with strong counterparties. So you'll see when I put up the dashboard that we have relationships with most of the major banks in terms of where we place cash, term deposits, the entities that we do, or the banks we do long-dated interest rate swaps with. So if I move on to the next slide, this is the dashboard, the PowerPoint dashboard that we use regularly in terms of when we meet monthly. You know, one of the key parts of that meeting is understanding compliance to policy. And you'll see there, this is the risk position at the end of February. And on the left-hand side there, you've got ticks. Ticks are good. Exclamation marks, not so good. And so what we're managing ourselves to is the interest rate risk policy, the liquidity risk policy, the funding risk policy, that's in terms of our debt management and our treasury investments. And then on the left-hand side there, you can see counterparty credit limits in terms of managing ourselves to the limits we set with the transactions we do with the banks. Green is good. So this treasury tool is the key tool that we sort of capture risk, measure it, and manage it and report the risk over time. So some of those charts may well be familiar to you, but it's the key tool that we use to manage and monitor those treasury risks. I think an important input into our treasury decisions is, remember, when we think about treasury, we're looking forward, not back, and we need to be assessing key inputs into how we manage our liquidity position, our debt funding position, and our interest rate risk position. And Council has an increasing debt forecast. That's the annual plan LTP debt forecast, the most current that we've got. So we're mindful of debt forecasts sort of going forward. I have to say, sort of a key observation from ourselves across the sector is that, yes, the delivery of capital plans, external constraints around delivering capital projects over time does mean that there is some uncertainty around those long-term debt forecasts, and we need to be mindful of that in terms of when we're implementing our treasury strategies. But also the policy and the way the policy has been set up is allows for some flexibility around changes in debt forecasts over time. And indeed, Standard & Poor's, which is your credit rating agency, when they look at long-term debt forecasts, they will sort of change them or haircut them, as we say, because actual delivery over time can be uncertain. But the debt forecast is a key part of the conversation that we have monthly to just understand what is happening around the delivery of the capital plan, how that influences debt forecast, and how that will influence the way that we think about liquidity management, debt management, and interest rate risk management. So in terms of the treasury management strategies that we're sort of focusing on, so this is the implementation of of the policy and just understanding council's ongoing liquidity and debt needs. So very much wanting to manage liquidity and funding positions within the LGFA financial covenants. So we need to sort of maintain those over time and over the sort of like policy limits as well. So that's a key constraint that's overlays all that we do around treasury risk management. What we achieve to do in terms of the prudent financial approach is that we like to spread and smooth our debt maturities. Now we've got a number of long dated and short dated debt instruments with the LGFA. So we don't want to have all of our debt maturing at one point in time. So we spread and smooth that risk and we reduce that concentration risk. And we have a number of techniques in terms of the way that we do that. But what we're trying to achieve is remove the impact of external shocks or external financial market movements which aren't anticipated in terms of influencing our council's borrowing costs, and obviously achieving actual borrowing costs that are close to plan. So we spread and smooth our risk so that we reduce our refinancing and repricing risk. And Mike will show you a chart later on where we just see how the credit margins or credit spreads that that the LGFA provides the sector, how they will move around depending on what's happening in debt funding markets. But spreading and smoothing is a key management tool that we've got within the policy, and pre-funding is a strategy that we do. So rather than wait until a debt maturity, and there's debt maturing in April this year, this month on the 15th, we will pre-fund that upcoming debt maturity. So we will raise debt in advance of that debt maturing, just to spread and smooth that risk around that debt maturity. Because remember, we've got core debt that is core long-term debt that is maturing, which is going to stay for a long time. We see that as intergenerational funding. And as you see from the debt forecast, we have new debt coming on over time. So we want to make sure that we average out or don't overexpose ourselves to market pricing at one point in time. One of the things we are doing at the moment is we're thinking about the LGFA and bank standby and working capital facilities. The LGFA has recently announced that they're providing working capital facilities, which is good for the sector and council in terms of funding short-term working capital requirements. At the moment, council uses ASB and Westpac for those facilities, but the LGFA, only in the last month, has probably offered that facility, which is a good pricing levels compared to the bank. So we're thinking about what can we be doing over time to not only reduce our all-up borrowing costs, but also make sure that our risk is suitably managed. And also, lastly, we're always maintaining a permanent liquidity buffer amount, just so we have the availability of cash at any point in time. And that's a requirement of the LGFA, but it's good, sound treasury management practice. So we're thinking about debt forecasts. If debt is increasing, we need to be maintaining a buffer above that over time. That's a 10% buffer, which the LGFA requires of us. And also that's a strength when we think about our credit rating agency, Standard & Poor's, in terms of the way they look at council in terms of the strength of your liquidity position. So here's a recent profile of your debt maturing. So you've got a number of different debt instruments, and there's some fixed rate debt, there's some floating rate debt, there's some on lending, obviously, to the dam, and we've got some undrawn sort of bank facilities as well. And you can see that, I suppose I fondly call them Manhattans. You've got a spread of bars or Manhattans over the next 5 years. So that just shows you how your debt is maturing over the next 5 years. It's spread over time. And you can see down below there the funding summary that shows how you need to spread your debt maturities, 0 to 3 years, 3 to 7 years, 7 years to 15 years. And you can see on the far right-hand side there, green percentages, 49%, 45%, 6%. So achieving policy and a good spread of debt maturities. And in terms of the liquidity summary, 114%, you've got to maintain liquidity above 110%. You've achieved that at 114%. So green is good. So that's current liquidity and funding position as regards to reporting to the policy. So the next part of the risk program is interest rate risk management, and Mike, you were going to kick off that, weren't you?
Good morning, everybody. Yeah, I will kick off interest rate risk management. Before I jump into that, though, when I was walking through your offices earlier, I did see that's very staticky. I'm quite a loudspeaker, so I'll just move that back. When I was walking around your offices earlier, not on my own, I was escorted through. I did see on a screen there was a thing popped up that said, "Hey, don't say TDC," and I just noted we've got TDC/PwC as a source on some of our slides. So apologies for that. We'll correct that for the next one. Yeah, but in terms of interest rate risk management, as Brett said at the start, it's all about proactivity. Goodness, that's very simple. How's that? Is that better? Very, very SE. It is all about proactive approaches. It's not so much about what the position is today, but it's what it looks like in the future. And that hinges on the debt forecast and what the certainty around that debt forecast is. And of course, the further out you go in time, the less certainty there will be. Everything is interconnected, everything links together. The policy isn't a whole lot of separate components that are just in one document. They're all intertwined, interwoven. And so interest rate risk is managed on a forward basis within the constraints of the policy, of the framework, using a combination of fixed rate debt and derivatives, primarily interest rate swaps, to build up that fixed interest profile. And we'll visualize that in a moment. Yeah, it is about managing interest rate risk as debt forecasts increase. The debt forecast is going upward over time. And there it is again, understanding that long-term debt forecast, it kind of underpins everything. It's really what's going to drive every aspect of it. So if we click this button here, there's a lot going on this chart, but essentially what you can see in the table on the left, that is the interest rate risk management parameters that you're operating to. You have a minimum fixed percentage and a maximum fixed percentage, and that declines over time. So 40 to 90 in year one, 35 to 85 in year two, and tracking on down. And that makes intuitive sense. Like in the very short term, over the next year, the next 2 years, you've probably got a reasonably high degree of confidence in that debt forecast. You know what those capital programs are. You know that they're probably already partly underway. You know they're being delivered. So it makes sense to have a higher proportion of fixed interest at that point in time, because you've got that certainty. That certainty declines into the future. And you can see the sort of the black lines on the chart, I guess, representing those upper and lower bounds. And it just so happens that because your debt is increasing at about the same rate that your maximum fixed interest profile is reducing over time, you get kind of a parallel line. So one offsets the other. So there are parameters. You don't want to be in a position where you have hedging that doesn't align with your debt, but you don't want too little hedging as your debt level increases. So that's why those parameters sit there. In terms of hedging, yeah, you have a pretty strong profile. You're well hedged 80% over the coming year. And that could also be outside of just certainty around the debt forecast, a management decision around, look, we want certainty for rates increases, which was very topical over the past couple of years. And so when interest rates fell and there was an opportunity to secure and lock that in, that could equate to potentially millions of dollars of interest cost savings over a short period of time. So it is very proactive. It is it considers the current environment, both in terms of the needs of the council, the needs of the community, and the economic environment, the financial market environment, what is happening in the world. We'll talk about all that in a moment, because there is a lot happening in the world right now. There's been a lot happening in the world for a while now. From one thing to the next, we tend to bounce. So that is how interest rate risk is managed, essentially. Of course, as time rolls on, that interest rate risk profile moves across and shuffles away to the left. So there is a need to be constantly monitoring and managing and taking advantage on a proactive basis, and sitting strategically between those minimums and maximums of policy. Admittedly, I flew through that pretty quickly, but there can be questions at the end if you'd like. We can always come back to this page. Financial markets update. Let's start here, shall we? Inflation, fuel crisis, all of that fun stuff. Incredibly topical. It's going to be impactful both from a council perspective and from a personal perspective as well. And I guess the way that we're currently sensing it or feeling it or seeing it is the pump price. You drive past BP, I think it's BP just over the way there, and diesel is now effectively the same price as 98. Like, that doesn't seem fair, does it? Doesn't really seem to make much sense, especially when you throw rucks on top of that. But we are in this incredibly dynamic scenario. I don't want to spend too much time dwelling on the mechanics of it, but essentially the world has lost, or currently does not have access to, 20% of its global oil supply. We don't really use oil. Very few people do use oil. Oil is kind of useless. It's the refined products that have real value, like petroleum, like diesel, like all of those fun things. We import petroleum is a big focus at the moment. Of course, the Prime Minister and the Minister of Finance get up on a daily basis and tell us how many days storage availability we have and all of these fun things. But fuel prices is where we're seeing it immediately. We're seeing it right now. We're seeing that filter through. But if we take a step back, or perhaps look forward a little bit, it's not the fuel prices that are going to be the real challenge. It's the indirect effects in the very near term. And for council, you are in the business of, amongst other things, putting pipes in the ground. And a lot of pipes are made with PVC, and PVC is a petrochemical. It's a function of petroleum refining. PVC polyvinyl chloride, that you can actually trade that on financial markets if you are so inclined. PVC future prices have gone up by more than 35%. Since the tensions in the Middle East arose. That is going to flow through into real costs if not addressed. There is no escaping it. Packaging for plastics is probably another easy one. You're in the business of building roads, and bitumen, of course, comes from refining oil. Helium comes as a consequence, or is derived as a consequence of that refining process as well. You might say, well, you don't have young kids, I do, so certainly filling up balloons. But outside of that, helium is used in the production of silicon chips, microchips. That feeds through into inflation everywhere. If you're going to get a new phone, if you're going to get a new laptop, if whatever you're going to do, that is going to feed through at a time where there is already demand for all electronic components through AI and data centers and everything else. So it's a perfect storm feeding through. And then fertilizers, which are also heavily dependent on inputs from that refining process, which feed through into food. And so transport, food, construction, manufacturing services, all of these aspects, the prices of these are going to be inflated over time. How that plays through depends really on how long the situation in the Middle East lasts. But we've got a second phase there. All we're seeing at the moment really is just a response to price increases. We haven't really seen the true impact of a supply reduction yet. And that's the grey on the right. The second phase is if we do see a sustained reduction in supply, that is when we're likely to see fuel rationing and or restrictions globally, higher funding costs, and we'll look at how that's starting to play out already. Household spending pressure, of course, ultimately rates have to be paid by households, and that creates tension. Reduced demand for exports. We are a small economy at the bottom of the world. We make our money by selling stuff to other countries around the world. If there is restrictions on shipping, if it's harder for things to get out the door, if it's more expensive to get things out the door, that's not great. Slow economic activity, resource reprioritization. There is only so much around there. volatility and interest costs, which we came back to, you're well positioned now. And so that's good. That's why you want to be well positioned, because there will always be this next shock, suppressed currency. It all sounds very grim, I know. And I want to be trying to have some sort of positive aspects in here as well. So the hope would be that this doesn't persist. But even if it stops tomorrow, and when we were preparing these slides and just tidying them up over the Easter weekend, yeah, every second day there's going to be a peace plan and there's going to be a ceasefire agreement. Late last night I was reading that Pakistan had orchestrated or drafted an agreement for peace between Iran and the United States, and that's subsequently been rejected. So this is all sort of playing out in real time, which makes preparing these charts quite difficult and challenging to talk to. But even if everything was stopped, tensions reduced immediately, there would still be a flow-on effect. It would still take time for all of this to work through, and those inflationary pressures are perhaps going to persist. So that is going to be a challenge that council may have to face moving forward in terms of those costs increasing, which then may feed through into the debt forecast. So you may actually find yourself maintaining that same level of debt, but delivering less. And so these are real conversations, serious conversations that are perhaps going to need to be had in the future. And then second round effects, perhaps more from a business perspective and a consumer perspective, but still relevant from an inflationary perspective. Confidence is falling, prices are going up, growth is slowing, so wage demand will be lifting at perhaps a time when the unemployment rate is holding up, because business may not be super keen on investing, but as a large employer, that has implications for council as well. And then that runs that risk of wages go up because inflation is going up, and then that drives inflation, which drives more wages, and you get the spiral, and you need a catalyst to break it, to change it. It's a lot, isn't it? Yeah. It's not a panic station moment, but it is time to start having these conversations. And we're seeing that globally in other economies where these conversations are being had, that there are challenging times ahead. And you hope that there's not. I was a Boy Scout back in the day. I think, Brett, you were a Scout leader back in the day. So be prepared. That's the motto. Be prepared. Plan for the worst, hope for the best. And hopefully that all pans out. We can talk about this as much as you'd like at the end if there are questions on this. Yeah. But in terms of what that means for council, I click that. Oh, is there a manual override? Oh, there we are. Press harder. In terms of interest rate costs, this is just looking really at the past month movements in interest rates, pre-Iran conflict and current. That is a material move higher. And from an interest cost perspective, council is well insulated at the moment. In your current year, the current year that we're in, you are 80% fixed. So that's a good thing. That's helpful. It allows you to spread and smooth the impact of those costs over time. If these do persist, you've got time to transition, to adapt, to adjust, to think about how you might want to manage in an elevated interest rate environment. What I don't like about charts like this is that they're so static, and that's not really how things are playing out. These things are bouncing around an enormous amount in real time on every headline, on every pivot, on every change. But that's not what council is doing. That's not what your finance team are doing. They're managing risk on a forward-looking basis so that they can look through the noise, through the volatility, and have a more certain outcome in terms of interest cost over time. Yeah, and very successful at that. They are. The OCR, that's kind of interesting, I guess. It's very easy to look at. It's very easy to understand. But you can see how this is kind of playing out in terms of the interest rate environment. Across the bottom of this chart, the grey blocks and the line, that is the projected, or basically an indication from the RBNZ back in February before these tensions emerged. Hey, look, here's how we see the OCR playing out over time. Maybe one OCR increase by the end of this year. A little over a week ago, the market sort of was still on board with that, but had priced a little bit more in. And then currently, as a consequence of this current inflationary environment or inflationary risk environment, the market is pricing in a significant increase to the OCR over the coming months. Cash rate going back above 3% by early next year, which is currently 2.25, so 325 basis point lifts. That will have impacts for mortgages, that will have impacts for council, that will have impacts for everything. We don't really want to get into the dynamics of how interest rate swap curves are constructed, but this impacts interest rates around the 1 to 3 year sort of space. Will this play out? Maybe, maybe not. This is a market view. The market doesn't always get it right, and it's the view right now. And this view will be informed by headlines, by shifts, by changes, by everything that plays out over the coming days, hours, weeks, minutes, months, whatever it might be. But this isn't a traditional inflationary environment. This is an external shock that's driving inflation. The RBNZ moving interest rates, that's about demand. That's the demand side of the equation. If the RBNZ increases interest rates, households have less money, so they spend less, there is less demand, that eases inflation pressures. When it's a supply shock, prices go up, households have less money, lifting the OCR, that doesn't really help that scenario. It's a challenge because inflation is still there. The RBNZ is still mandated to maintain inflation within a bound of 1 to 3%, but that is over a medium term. Much like a council, you're not looking at the headline here and here and here and here. You're looking at that longer term perspective. You're managing risk over the long term, spreading and smoothing to get a consistent outcome over time. And that's what the RBNZ will be looking to do as well. So charts like this, the market's pricing in 3 OCR hikes to the cash rate this year. It's quite alarmist, but it may not pan out. It's so much more nuanced than the Herald headline might suggest. What do we got next? And borrowing costs, LGFA borrowing costs over time. This is the other component to it. You've got interest rate costs, and then you've got funding costs, your cost of borrowing from the LGFA, AA-. That certainly helps on a relative basis. That applies some downward pressure to your funding margins. But you can see, I haven't got a light thing, on the right-hand side, yeah, that has spiked higher as a result of what's happening globally, because there is uncertainty, because there are all of these factors feeding into the current economic environment, and that's pushing the price that the LGFA receives when it issues debt higher, and that's filtering through into the rates that the council can borrow at. So it's still down on where it was previously, which is helpful, but in trading circles, they say trend is your friend, or in this instance, trend is your frenemy. Because that is not a helpful trend, funding costs going higher, because that then feeds into council, especially if you're borrowing on the longer term. But you're spreading and smoothing that risk. You don't have to go out and reprice your entire debt profile tomorrow. 46% of your debt is repricing over the next 3 years. You're in, you're out, you're doing pre-funding, you're not 100% committed. It's not your mortgage where you're fully fixed in the 2 year and interest rates are low today and you hope they're still low in 6 months' time when you reprice. Council is constantly in managing that risk on a spreading and smoothing basis. So in summary, I might hand back to Brad because I've spoken for a lot, and I appreciate that I'm a bit to take on. Yeah.
I slow down, Mike.
Slow down, yeah.
I think the message there is that is going to be.
Oh, I'm sorry.
I think the sort of message there is that external shocks will influence New Zealand Inc. and will influence wholesale interest rates and also funding margins or credit spreads. And we've got to be able to manage our business council independently to those. And hence the spreading and smoothing takes away some of that volatility. And as Mike says, it gives us time for us to react in terms of our planning cycle and making some decisions, which may be a result of what's been happening globally to us. So I think that word proactive management is key. So looking ahead and, how do we manage treasury risks in an evolving economic and financial environment? There's uncertainties around some of those key inputs. And I mentioned the debt forecasts earlier, and I think that's one of the key challenges right across the sector in terms of the delivery of that plan and the debt funding thereof. Always find comfort from a governance perspective knowing that you've got a policy with parameters that have been set against a risk environment of a prudent financial manager. So we're not trying to trade financial risk for going. We're trying to sort of manage and protect long-term plans and your annual plans as well. You've got to have an accurate capturing, measuring and monitoring reporting of your treasury risks, because that gives us comfort in terms of looking ahead and really understanding what residual risk we have as council that we need to manage. And that treasury tool is a key part of ensuring that we manage our treasury risk in an environment of, a controlled environment. Monthly meetings is what we want, because it's an ongoing conversation. Things are happening quickly. I think a conversation around financial markets last month or the month before would be a very different conversation to what we're having now. And so it's a regular conversation, regular meetings with Matt and James. The treasury management approach is consistent with sector good practice and treasury management good practice. So what you're doing and the tools that you're doing is best practice. So take comfort from that. And you're using a variety of tools, a mix of instruments, debt instruments, and interest rate risk instruments, and that's important in terms of what you're trying to achieve around medium to long-term treasury management. So that's really where we wanted to leave it. And I think maybe it's time for questions. Yeah.
Okay, I've got three people, and I'm going to have the first one. There's got to be some privilege of being chair. The one good thing I see is there's an election in the United States on the 5th of November, so gas prices will affect Trump's election result. So, but you've got a statement coming this week from the Reserve Bank Governor. What are you expecting there? That's my question.
In short, we don't know. It's highly unlikely that she's going to speak with regard to the outlook for monetary policy outside of a formal monetary policy meeting, but it's likely to reinforce that view around the inflation story. Look, this is an inflation shock. She is likely to reiterate, as she's done previously, this is Dr. Anna Bremen, that she disagrees with market pricing for the path of the OCR. She's likely to say that, hey, as she said previously, increasing the cash rate is perhaps not the most immediate or not the most appropriate response at the moment. There is so much uncertainty. Things are playing out. She is likely to suggest that sitting on their hands, so to speak, is the most appropriate approach here. That market pricing feeds through into everything. It feeds through into mortgage rates. You would have seen mortgage rates have gone up recently, and then that impacts households. But interest rates are built on expectations, market expectations, and those expectations shift and change. The RBNZ governor and the RBNZ board, they can exert some pressure, especially on interest rates, up to around 3 years through what they call jawboning, by talking tough, by a great line from a central bank when they're trying to achieve something is saying something like, we will do whatever it takes to maintain our inflation mandate over the medium term. And it's hard hitting. That drives a movement in markets, despite the fact that that's their job and that's what they always do anyway. Their job is to maintain inflation within that 1-3% band, but over the medium term, they can't really do anything about these shocks other than support the economy and say nice things and try and manage the curve as best they can. So with all that, I don't want to second guess or try and preempt what Dr. Bremen might say, but it's likely to be along those lines.
We're going to go a little bit over time, but I'm sure councillors want to do that. So Councillor McNamara, I've got about 5 people. Quick, concise question.
Thanks for your report. Last time I was sitting around this table was around COVID, and you were talking about doves, and I said you were acting like ostriches. So I'm pleased to see you're more in tune with the world situation. But my question is around risk in our absurd debt trajectory, which we currently can't afford our debt without borrowing, adding to our debt to pay for business as usual. So I'm wondering if you're considering things like the fact we've been on a high growth trajectory in our figures, and we haven't been meeting high growth for the past 3 years, and there's no foreseeable sign of it happening in the future. does this sort of thing factor into your risk profile of where you think we can afford?
Through the chair, I might say this: the information, the fundamental underlying information that PwC get is from council. So that's the information that they work with. So our debt profile, which is the key piece of information that they've alluded to, currently stands at 452 million at the end of 2034, based off the 2024-34 LTP. Obviously, that's up for discussion. That starts tomorrow. So if that debt profile drops considerably, so does what PwC essentially needs to manage. The other thing I'd quickly note, sorry, Council McNamara, is that Treasury policy that we did allude to, that does come back to full council, and the council agree those limits, etc., that we're currently working to, and change them accordingly.
Yeah, but my question is more around the risk of us being able to afford where we're going based on the fact that we're not getting the growth to pay for it, and the interest rates are projected to skyrocket. Things are not looking good. I'm just wondering whether those figures are presented.
Can I keep it to one question each, because there's 5 people and we're running out of time?
I think, through Mr. Chair, it's still not necessarily for PwC to comment, and perhaps Brett would like to confirm that from his perspective. But the base information is for the council to decide and agree. It's then for PwC to manage that under that underlying Treasury policy. But Brett, through
the chair, a very important part of the policy review, which is coming up, is setting your net debt to total revenue percentage. There is a requirement from the LGFA to be no greater than 280% of your total revenue. You would typically set that lower. If I remember correctly, at the moment it's at 225%.
160.
Yes. So that's where their input would be in terms of influencing where your debt would be going over time. So it would be very much sitting with council, that decision. Yeah.
Okay, so it's one question each, all right, not 2 or 3, because I've got a number of people with questions. So Councillor Neubauer.
Understood. Thank you very much, Mr. Chair. Thank you very much for a very invigorating and interesting presentation there, in pointing out that, we're in a high volatility, very volatile financial market environment, and increasingly so. Historically, seeing those events kind of just accelerating. So in this, I picked up on you talking about us being well hedged and well set up for the current shock that we're facing, with 80% of our debt being fixed. But if I saw this correctly, then our debt is only fixed for very short amounts of time, given the life expectancy of the assets that we're actually financing. So keeping in mind that a lot of assets are intergenerational, with life expectancies of 50 to 100 years, a lot of the debt that's actually financing these assets is only fixed for 1, 2, 3 years, and after that it peters off. So we're actually very exposed to this volatility in the market. Wouldn't it be much more prudent, and wouldn't we be much more hedged if we fixed interest rates for a much longer term?
Yeah, I don't disagree. And I think, again, it comes back to the way that you set the interest rate limits within your Treasury policy. It's trying to get the right balance of, yes, managing your risk, but also giving yourself flexibility for changes that will happen over time. And one of those key changes is debt forecasts. We have found in the past, and this was a strength of the local government sector, is the long-term planning process around asset management planning and long-term plans, etc., etc. But those plans do change, And you don't want to be in a situation where, an uncomfortable situation where you've gone and done long dated interest rate hedging and the debt doesn't eventuate. And you find yourself in a highly fixed or over-fixed interest rate environment. So it's how do you get the right balance? And that's why I say with treasury management, there's art and science attached to it, because there is future uncertainty. So you've got to sort of set a policy that gives you the comfort that you can go up to a certain level of interest rate protection over the medium to longer term, but not get you into a situation where you're living with an over hedge position over time. So what is the right balance? And I think that's a good conversation to have when you're fundamentally looking at the policy parameters. Yeah.
Okay,
So that would
Councillor
be my
Morgan.
response.
Hello?
Yep, Councillor Morgan, your question?
Oh, thank you. Look, you noted the total debt and net debt in your slide conversation regarding slides, and you had a figure of 444 million there. Total debt, I'm presuming. My question is, if the total debt, the Waimea Dam debt, the risks associated with it, if it dropped to become part of the net debt, what implications, and our policy was operative, how would we manage that risk?
Through you, Mr. Chair, my apologies. I'm not. Councillor Murray made a comment then that I chuckled at, because I'm going to attempt to answer it. So the 452 million net debt at the end of 2034, it's not gross debt, it is net debt. That does not include the pass-through costs associated with Waimea Dam. The risk of that is if Waimea Dam or the irrigators are not able to provide the payments on those loans, that's where the risk will eventuate or come to bear. Obviously, there's a lot of things that would happen in between that before we even got anywhere near a position like that. But fundamentally, we would need to be looking at our treasury and risk policy, treasury policy, with that in mind if it did eventuate. But as I say, that is there's many hurdles to go through that. For example, we're getting a update from Waimea Water Limited on Thursday in a report that's coming on the 9th around the position, etc. So there's plenty of opportunity to see that and react accordingly.
Thank you for that. Councillor Kittermont.
Thank you. Through the chair, I'll try and keep it short because we're getting told off. Liquidity ratio, 114%. My question is, if we could increase that, so have additional funds in the bank to cover off special weather events, so could we go up to say 120, 125%? So we had extra money in the bank, as opposed to trying to work out specific rates, targeted rates. Do other councils do that sort of thing, like have a holiday fund in the bank, so that if there's a sudden need for funds today or tomorrow, but that shush.
Yes, and again, I come back to the policy. The policy will be very clear in terms of how council would fund the disaster recovery or disaster relief, and typically that would be through that liquidity buffer requirement. But you'd probably maintain that through. It's probably a more cost-effective way to just have unused or available committed standby facilities, rather than having cash sitting at the bank. Yeah. So the commitment will be, that cash is available to be drawn down under those facilities. So that's how you probably manage that risk.
Right. Councillor Woods and then Councillor Gully.
Thank you. I enjoyed your report, and I am interested in the problems seem to be reasonably acute, and you've talked about looking at reductions of service or delivering less, I think was the way you phrased it, for as a response. What advice have you given the management about delivering less without triggering the auditor's requirements on the long-term plan or annual plan?
Yes, sorry. The comment I made on delivering less, that was more perhaps this is a conversation for the future. If there is an environment where there is a reduction in supply of oil, petrochemicals, of all of those inputs, roading, or there is an increase in costs associated with those dynamics, then that would be a conversation that council would want to have, and those are conversations that we have to be a part of and engage with management. But it's not something that is happening necessarily right now, but it is something to think about for the future if that scenario does play out. Yeah, sorry, apologies, that was confusing. Yeah,
I think it was a general comment, and I think that it's a comment that also has been made by Standard & Poor's. It rates a number of councils, it rates your particular council. They're getting themselves a little bit tied in knots at the moment because obviously there's discussion about rate caps, rating caps and those sorts of things. So I think it's just a general comment or discussion going on across the sector in terms of, okay, so how do we manage ourselves through that? And it wouldn't be necessarily a Treasury response. It would be more a business-wide response.
Okay, thanks for that. Councillor Gully.
Thank you, through the chair, gentlemen. Very enjoyable but sobering presentation from you. Debt is debt, and look at those scary projections, and they are scary. Where do we sit against similar size councils in the country?
Through you, Mr. Chair. Again, on tomorrow, I actually think we bring back some comparative figures around debt and where we actually sit as a regional council in the local government space. Those are actually slides you've already seen, but I know they're part of that info pack actually that you received on Thursday. So from memory, we're mid-pack. The comparison back to a local industry might not be the most appropriate comparison, perhaps, but that's the one that we're at least aware of and is our cohorts, if you like.
Okay, well, thank you, Brett and Mike. That's been excellent today, and it's always a pleasure to see you. I think you're going to stay on because we're going to go to our Treasury report next. So you might want to sit in the back. Well, I think James has got to deliver that. So again, it's always good to hear you and see that we're following the correct processes, but it's a difficult time for the world. Now, if I look at some countries in the world, they're in much worse positions than us because some have had to have huge restrictions because they just can't afford to pay. I was reading what was going on in the saw what was going on in the Cook Islands. Didn't look too flash when it was going to be $7 a litre there this week. So there are places in worse positions in New Zealand. That's what I've seen overseas anyway. So thank you. And we'll ask, so we're going to 7.4 and then we'll go back to 7.2. So Matt.
Okay. Through you, Mr. Chair. Firstly, thanks to Brett and Mike. Always appreciate them coming down to shed some light on a rather complex area. That we alluded to the Treasury policy essentially in that presentation. So part of that is the report back. In that Treasury policy, it talks about a quarterly report back, and essentially that's what you're seeing today. So all the key ratios, etc., that were touched on is what the presentation or the report that James is just about to touch on basically alludes to. So I'll pass over to James to make some comments before we open it up for question.
Kia ora koutou. I'm going to assume everyone's read the report. So the good news is that our cost of borrowing is still below what we budgeted for. That's a mixture of good lucky hedging and good interest rates. The bad news is that the average interest we're getting on borrowing is actually a typo. So it's not 23%, it's 3.15%.
And just to correct James, it's not so much lucky. It's rather that it's a reflection of that monthly conversation that we do have. This is obviously a material number and warrants us discussing it with the experts and getting it right. Because if we don't, it does come back to bite and bite pretty quickly.
The one measure that we haven't actually succeeded on is actually one of the measures from the Treasury policy. And that's not so much we haven't actually achieved it, but we've actually got the wording wrong. There's an oversight in the when a measure got changed last time around. The measure is that one that we've been talking about quite a lot, the external debt related to revenue. We're supposed to be reflecting the limit from the financial strategy, the 160% one. Unfortunately, when we modified the Treasury policy last time around, we forgot to change the wording, which said these have to be last year's annual audited figures. So we're comparing current debt to last year's revenue, which gives to a really erroneous 161%. The actual results, which is when you compare to our forecast revenues, actually improved because our forecast revenue has gone up by about 33 million since the beginning of the year. So that measure, relax, is actually doing really well at 126%.
And just further to that, we intend to make the adjustment to the Treasury policy when we come and talk to you about it over the next few months to make sure it's like for like rather than the current year versus the previous year. Happy to take questions.
All right, well, I'm happy with that. Questions around the table? Councillor McNamara.
Thank you, through the chair. 1.9. Were all of these the CIIL interest-free facility, the environmental loan and the Waimea Dam term loan, were they all debt funded? Renewed?
Through the chair, yes. 1.9.
CIIL is Crown Irrigation Investments Limited, basically central government funding for these kind of projects. And yes, it is that they lend money, they don't give money.
I'm just trying to understand. So this paragraph is about portions of loans that we have refinanced by more debt.
Yeah, the point of that paragraph is really to give you a progress indication of how much of that interest-free loan is gradually transitioning to LGFA funded stuff. So there's still quite a lot of it. About 3/4 of each of those two ones still got quite a few years to go of 0% interest, which helps that net borrowing cost.
So through the chair, my point is that the first 2.5 million of the Waimea Community Dam environmental loan has been refinanced in debt rather than paid off via the commercial activities account, which is what was consulted on, correct? If I'm correct.
Yes and no. So when we say it's been paid off in the sense you talk about, in that surpluses from other activities have been applied against it. But in terms of we've physically used money from the bank account to pay for it, yes and no. When we manage our treasury, we try to manage the net debt. So we say if we need funding, then we'll borrow it. If we don't need funding, we won't. So on the balance sheet side of it, yes, it's been paid off with surpluses from other activities. In this case, commercial, isn't it?
Yes, forestry.
Yeah, but in terms of whether it's affected our net debt or not, at the time, no, it didn't, because we had cash in the bank. But later on, when we look at, actually we're about to do it now, and we say, when are we going to need a whole lot more funding? That would be the point we say, well, did that activity pay for it with debt, or did that activity pay for it with cash? So at the time, yes, cash. But like I say, overall, you'd have to stay above zero.
It's just we consulted on that money, 15 million or whatever it was at the time, was to 7.5. I'm not 10 in the middle. That was to be funded from the commercial account. So my drive has always been to ensure that money is being put aside out of commercial activities to pay for that. Otherwise, it does exactly what you're talking about and adds to our net debt.
Apologies, through you, Mr. Chair. The 10 million has been what was earmarked to come out of the commercial activity. So that is the intention. That's where it's being paid. There's actually been a subsequent report to council just before the new triennium started, where Crown Irrigators Limited approached council about the payment of that debt in whole for a discounted amount, which was agreed by the previous council. So there are discussions in place. Regardless of that, the funds are in the forestry account, or were in the forestry account. We've actually taken out of that and put them into the Waimea Dam account because we knew this transaction needed to occur. The fact that it's a discounted amount is more attractive to council. But again, I'd point you in the direction, and I'm happy to share it with the report that I think was mid-September went to council, and we're just about, or in the process of concluding that contract with, that agreement with SIL, with Crown Irrigators Limited. So definitely, it was from forestry.
All right. Other questions? None? So could I have if not, we'll look for a mover. Councillor Nobauer and Councillor Gully is a seconder. No other questions? So we've just had an hour on Treasury. So no? All right. So I'll put that we've received the report. Easy day for you today, James. All in favour of receiving the report, please say aye. Against? Carried. Right. Thank you, James. And again, Brent and Mike, good to see you again. We will watch this space with interest over the next, real interest. Low interest, but real interest with what happens. And I don't think we have a lot of control. We'll now go to the 7.2, the financial report. So we have Paul and Matt, you're still sitting there. Busy day. So this is on page 14.
Through the chair, Kia koto councillors. This is a financial results for the period 1 July 2025 through to 28 February 2026. Results are tracking in line with recent months. So there are some items to note before we go to questions. Again, insurance proceeds from the weather event have not been yet received or recognised. There is a review of emergency event related expenditure as normal towards the end of the financial year, which may reclassify some operating expenditure to capital expenditure. We have included some additional information on capital expenditure regarding the top 10 forecast capital underspends. And at the last meeting of this committee, councillors asked questions on the financials, and we have included some content in relation to this in section 9. Thank you.
Right, so I've got a question, but I'll defer to others first. So Councillor Kittermont's first.
Thank you. Through Mr. Chairman, sir. This bloody weather event happened 10 months ago, and we're still going around in circles with insurance payments and all the rest of it. Has the insurance provider given us any indication when we can get a decision on this?
Through you, Mr. Chair, I am not the expert in this field. I know there's a report coming to council in a few weeks from memory to an information council agenda. Deirdre Hamama is the person that's actually conducting those negotiations, if you like. I'm 99% sure she's in attendance and will be able to give council an update on that.
Could we be cheeky enough and start to answer some of the interest rates on the money that's outstanding? No, don't answer that.
One thing you do with insurance companies is you don't alienate them. Having worked as an insurance broker, I know people that have lost cover because you don't alienate them. Councillor Nobauer.
Thanks, Mr. Chair. I really appreciate your report, and especially that you responded specifically to those questions that were asked at the last meeting. And I appreciate that the question that I asked was a loaded question. Obviously, a pipe in itself doesn't produce any revenue. However, if you tag a pipe and a road and everything that's required to provide the infrastructure for a neighbourhood, then they do provide revenue. So my question to you is, and I think this is information that is incredibly important for us as a council to make decisions, because we have ideological discussions here in the chamber about, how to adjust our rates to, be fair. So we need data to understand, what areas incur which costs to be able to align the rates. If we choose to do so, we need to choose what sort of growth we want to encourage through our plans. And we need to understand what sort of service levels are affordable. So my question to you is there a possibility to tag capital expenditure to a geographical area? The same with operational expenditure. And I do appreciate that some of these infrastructure projects are not specifically for one area, but they may be for 2 or 3 areas or even more. So there is always a potential for, percentage breakdown for the various areas to get this sort of visibility. And, just question, is it possible to provide that sort of detail for us?
Through you, Mr. Chair. Firstly, thank you for the email asking this question to give me a bit of time to have a think. That level of detail is difficult. Essentially, our ledger as it currently stands does not allow us to do that. You alluded to percentages. And that is a possibility. The reality of the percentages, though, is that needs to be provided by somebody who actually understands and can actually make a call on the percentages, be it a capital project that goes over, and again, what's a neighbourhood, but numerous neighbourhoods, or indeed operational spend that potentially goes right across the whole district at the moment in terms of the actual invoice we get. So it's certainly something that we need to consider when we're looking at the modern finance solution that we've touched on previously. That level will certainly be challenging, but if it's a consideration that we have on board, as we do, then it's something that we can consider as we're figuring out the way forward and the type of information that we need to provide councillors, as you say, to make the most informed, best informed decisions that you can. We're certainly not in that space at the moment, unfortunately, and it will be a journey to get there.
Thanks for that. Just before I go to Councillor Woods, just a question from me. Paul, have you had a heads up from our roadings people about the damage on the Sandy Bay Marahau Criteria Road at all? I drove it on the weekend and I certainly saw where work had carried on from the event we had about 3 weeks ago. And I note that road is going to be closed for 4 weeks, the one over the hill. So have they talked to you about that at all yet?
Through the chair, nothing in particular. But I would expect that to be part of the ongoing program of works coming from damage from the weather event.
Yeah, well, it's a separate weather event. It was the one only, about 3 weeks ago, where there was quite a bit of rain, Criteria Marahau. So it'll be interesting to see what the cost of that is, because it's certainly the repairs have started, and there's some repairs due to happen in the starting later this month, I think, for Marahau. All right, Councillor Woods.
Thank you, through the chair. Another good report, Paul. I like your reports and I like the format and detail in them. I'm focusing on the underspend in the capital program. This is a bugbear of mine. I primarily think of the council as an infrastructure company, and capital spend is necessary if we want to keep the infrastructure up to scratch. So Yeah, it seems like we've got an enduring issue here around the underspend of $30 million, give or take, underspend currently and year to date. And that's on top of the underspend from the previous period. So given that the capital budget is set around assets that we need, maintenance and pipes, tanks, pumps that we need, I'm imagining that we are pretty much sweating assets that are going to give us problems in the future if we continue this track. I'm interested in the KPIs, what we're doing to look at measure the performance of getting the spend completed, and also our supply chain security. If it is a supply chain security, I know that there's been some things there around access to land, projects being deferred, but even if we add up all of those top 10, that's only 20 million. There's still another $9 million out there that's additional underspend. So I don't expect you to solve it here and now in this meeting, but I think it's going to become an issue, and I'd like to hear your initial thoughts on it and what the ELT is doing to bring this into some sunlight.
And I see Russell's come to the table while I was looking down and making some notes. And Russell, you're going to reply.
Yes, thank you for those questions through the chair. We're aware of the capital unspend. There's many reasons for it. By and large, it's more of a phasing problem. Like in the top 10 of the major projects, Redwoods Valley is down there, $4.5 million of underspend. All that work will be done in a few months after the new financial year starts. It's more of a phasing problem. We can't always guarantee we know all the land access when we first put them in the long-term plan. We couldn't start until we get approvals to go through people's land. So they will all be delivered. It's not about sweating assets. None of those delays are due to us deciding not to do it. The most common one is land access that delays our projects. And you can take up to 2 years to get land agreements with people, because we are knocking on people's door to say we want to go through your driveway or through your paddock. They don't always say, yes, help yourself. And that's fair. What we have done over the last months is put together a framework for one prioritisation. Because another reason we have this underspend, and it's underspend only in the current financial year, annual plan year. In terms of deliverability, in terms of construction, which is where 80% of our money is, 95% of our projects are on time. That's the construction. That's 80% of the budgets is construction money. It's the plan to get them to construction. And it's about overcoming some of those constraints by having better business cases at the beginning, so we understand where those constraints are, like land, so we can solve it before we get to trying to build something. The others, we currently don't have a flexibility in the system. So if there's $4 million we can't spend at Redwoods Valley, I can't go and grab something from next year that needs to be built easily without coming back to council to move money. But with a prioritisation list, we'd be able to have projects we're delayed, we could go to the next one on the prioritisation list and deliver that one. And that would close the gap, because that underspend is not underspent. It's not spent in the annual plan year. It's delivered in the year after. So the asset's still built. But from a planning perspective, if you want more certainty, if you put $80 million aside, or 60, it's actually spent with some certainty. And that requires better planning, which we're putting in place, but also the flexibility when things are uncertain, as they are in the world of projects, that you can actually take other projects to fill that void when that occurs. And we're not having that ability at the moment. So I've got 20 projects to deliver in water, which are all there in the plan approved, that I can't touch yet, because whilst they've got underspend here, they don't have their financial commitment to it until the next year. And that's beyond my control without going back to council to get that money shifted from the future year to now. That's a solvable problem. We're aware of it, and we would like the problem to go away at least 98% of the time. We live in an uncertain world. So we are familiar, we are working on it, and it requires two things: better planning, which will be put in place, and some flexibility in how things are funded. So when something stops, there's another one you can add into it to use the money in that financial year.
Okay, thanks for that. And it's been a perennial problem, and I know Russell and I have talked about this flexibility before. I'm going to go to Councillor Walker, and then I've got second questions from Councillor McNamara and Kinmont, and I hope someone is going to move the report. But Councillor Walker?
Yeah.
And Morgan up.
Thank you, through you, Chair. When you were talking about the Sandy Bay Road and Mudhoe Hill, so those roads were significantly damaged June, July last year, and the work that had been done is program work post those storm events. And you are absolutely correct that those two roads were closed again just recently due to, again, the weather. And Mudhoe Hill was going to be first, but we got a very clear line of communication from our local community out there that was going to hinder them in their busiest tourism season for us to close the Mudhoe Hill. So we renegotiated to do Sandy Bay first. But you are right, there is ongoing work that continues to happen, and the recovery will be more costly now because we've had yet another event. Going to my question that I actually had was to Russell. When you say we probably should be doing better business cases, can you clarify what you mean by who should be doing a better business case?
It comes out of our planning team, the long-term forecasting infrastructure, 30-year, 10-year, and then into the long-term plan. We don't have business cases for our projects in place. And which means when we get the project delivered, there's some things we're not aware of until we get our project brief and we go, okay, there's some constraints in here. So we're aware of those business cases need to be done. We've currently put in a system to capture some business cases, so we have better planning and therefore less constraints when it comes to delivery.
So from what I'm hearing you say, that these business cases will be bulkier, more accurate when we move forward, because you've just acknowledged there's a problem and you've got to work around?
Yes, we have acknowledged the problem, and it's the business cases not only establish why we're doing these projects, so we're actually doing what we need to do. They also can understand some of the engineering constraints or other constraints, not all engineering, and you have more time to solve them because you're aware of them earlier. If you get to brief, like I get lots of briefs, usually I get my briefs about now, and if we find some constraints, it's quite difficult to solve them in that one particular year if they require purchasing, looking for groundwater, understanding the quality of that groundwater before we can put a treatment plant on top. If we know them 2 years in advance, much easier. And the other one is some flexibility.
Thanks for clarifying that. And part of the delay of getting Mudhoe Hill done was the scope of the work and the design. So, yep.
All right, I've got 3 people and I'm hoping someone's going to move it. Councillor McNamara, you had a second question?
Happy to move it. As soon as I haven't asked my first question yet, then I'll start with my second one. 6-7 years ago, I seem to remember we were given delegations away for exactly the purpose that you're describing of being able to bring projects forward if one gets held up.
Through this year, and answer your question, it was about 6 months ago. There was an agreement whereby we could go to the councillor procurement panel to shift money from a future year to now. That panel has only just been established in this financial year, and we've yet to be able to use it for that purpose.
As I say, I sat here 6-7 years ago. Mr. Kirby's first year, he came and he told us he was going to sort this problem out, so it went away. He didn't. That year, we were told we needed to appoint more managers. We did. The next year, he didn't deliver. It was because programs got held up. I'm sure we gave delegation that that kind of movement could be done, so the problem went away again.
Well, it obviously hasn't, but there's some work been done now. So have you got a question?
Well, that was the second one. My first one. The joint cemetery capital, $3 million. Is that $3 million of allocated funds sitting there unused?
Through the chair, that is a project which has been on the books. That is the joint opportunity with Nelson City. Grant here may be able to provide more detail.
I also sat on that joint committee, and we ended up not getting an agreement with Nelson City at one stage. So, Grant?
Yeah, through the chair, that's correct. Nelson City decided they wanted to, withdraw from the regional cemetery business case, I guess, or planning. So that's where it's been left for the time being. although we are looking at Tasman solution alone.
And options being reviewed, what does this mean? Like, how far away are we going to see an option?
So that'll be part of the long-term plan programming, I guess. So we're looking at sort of initial opportunities out there. We had been looking at purchasing land previously, but if there's some way that we could look at existing reserve land holdings and take that approach first, then that would obviously be advantageous. But there's quite a lot of work to be done on it as yet.
The Richmond Cemetery's got about 8 years left, I think, isn't it, Graham? So we have to do something in time. Councillor Kittermont. So I've got a mover. I'm looking for a seconder.
Through you, Mr. Chair, I'm happy to second. The discussions around the table here have been about the capability of us to get the work done in time. And I'd just like to put a plug in there for the project management team, who are a relatively new team, who are realising where the gaps have been in the way we've produced our capital works over the past, and are plugging those gaps in as best they can and trying to make it work the best. So thank you, Russell, for all your expertise, what you're doing around here. I know you've got a big, steep curve to go ahead of you, but I'd like to congratulate you on getting this far so soon. That's not a question. My question is next. Page 20 on the capital expenditure under environmental services. You've got 3 budget items here with zero budget with the letters HPC against them. Can you just explain to me what HPC stands for?
Through the chair, thank you, councillor. That is an acronym for Home Profit Centre, which is how we describe some of our cost centres which hold non-infrastructure assets generally. So usually it's stuff like computer equipment, vehicles, and similar sort of non-infrastructure assets, capital budgets.
Right, I've got Councillor Morgan with a question. Councillor Morgan, did you hear that? Have you got a question? Your hand's up.
Yeah, apologies, Mr. Chair. I put the sound on, but it turned itself off, or someone did. My question's around 4.1, our statement of comprehensive revenue and expense. We don't do a reforecast, so I find myself mentally doing it as I look at the numbers. But my first question is, from a revenue point of view and an expense point of view, if they could comment on where they see us landing at the end of the financial year. But the second part of the question is that we've got a number of lines in the, particularly the revenue side, that I'm assuming that they will look at and are flowing into the 26-27. Well, no, the AP that we're consulting on. And some of them are clearly not going to do the budget this year, like the DCs. And actually, when we, how we're addressing that in terms of being more realistic in what the budget should be. We haven't seen, I haven't seen, a fuller budget, so it's difficult to get a sense of, it's an increase in cost, but where it sits in the various lines. So I appreciate some comment from management on that. Thank you.
Paul?
Through you, Mr. Chair, I will answer this with Paul providing further info if he wishes. Certainly overall, if you look at total revenue, we're certainly ahead of the budget, and indeed total expenses. A big driver of that is the disaster recovery costs, and indeed the expectation in some instances of additional revenue from Waka Kotahi in particular. Certainly there are line items there that do feed into the annual plan. Development contributions is one. So what happens is, again, it feels like this is the answer every time, but every 3 years we do a long-term plan, which is our opportunity to actually reset the development contribution amounts, if you like. So in this particular instance, certainly the DC revenue has fallen away, and it's unlikely that we'll make the budget of $14.8 million at the end of this year. That will feed into next year's financial model, if you like, when we're developing the LTP in terms of resetting the actual amount that we need in that space, as indeed will the other side of it. Obviously, revenue is one side. The other side is actually how many or how much capital we spend on growth-related assets is the other key thing. So that will be part of your overall financial strategy that we start talking to tomorrow. So it is difficult to say. The emergency event really does skew the results when you're looking at them on a front face of a profit and loss, which is essentially what we're doing. Once you remove those, though, I think even with the additional maintenance costs that we're experiencing in Three Waters, it's more likely than not that we'll actually end up pretty close to the budget this financial year, with the exception being those emergency events. We're not going to be able to recover that by some miracle. That will be an overspend, as has been touched on, and it's because why we've got the new targeted rate that we're currently consulting on. Paul, you could answer more, or we could go back to Councillor Morgan and see if we've provided enough information.
Look, I can understand your commentary. What I'm trying to understand, if we do a budget as is put forward at the beginning of the year, we know we potentially won't do the capital spend. There's significant maintenance spend there, but we use the word maintenance, and I'm not clear on the definitions, because there's reactive maintenance, event maintenance. There's the normal maintenance in the budget, and then there's a reactive one, but we've got extraordinary, I would call it extraordinary maintenance cost associated with the event. So it's not clear that actually our normal program of outputs is being met, or has dramatically fallen behind like the capital program. And looking at these counts, the numbers don't tell the whole picture.
Through the chair, thanks for elaborating, Councillor. We do have a section on page 18 giving a little bit more insight, and I'll be the first to say it probably doesn't go quite as far as you'd like, around our maintenance and the impact of the extraordinary events with the emergency events. That does give a bit more breakdown of what we see as best as we can for our financial system, our BAU programmed maintenance program versus the cost for it, and also gives us some detail on the scale of cost for the emergency events.
Through the chair, just to add to that table 4.13, table 3, does talk about the emergency event. So obviously that's unplanned. There's no budget for it. We didn't know about it. We're in terms of the other classifications of expenditure, we have reactive, which again we don't know exactly what it's going to be. Hence the word reactive. We literally budget for a provision and hope that is sufficient to meet what will actually eventuate in our systems. And unfortunately, with Three Waters, you can see that we didn't allow enough. That's what's causing those overspends. 8 months through the financial year. You'll also note that transportation is slightly behind budget, or $2.1 million. Again, that work tends to have been coming through in the month of January, February, March, April. So I would expect that to be timing in nature and to actually correct itself as the year progresses. But yeah, we could certainly talk to the engineers. I know there's reactive, I know there's routine maintenance, and there's one other category that maybe Mr. Kirby could help me with, but I know we do classify it to 3 particular areas, especially in the 3 water space.
Okay, thank you for that.
Thank you.
All right, so no more questions because one person won't go. Councillor Woods, final question, and then we'll put this. We might get out of here before 1.
Thank you to the chair. I think the last time we had the report, I was interested in getting the balance sheet with the numbers from the previous year. I'm not sure about everyone else, but I take a lot of value out of the previous year for a balance sheet. So just not a question, but really a comment if we can see that. Thanks.
Okay, so the report has been moved by Councillor McNamara, seconded Councillor Kittermont that we receive it. I intend to put that. All those in favour, please say aye. Against, carried. Okay, so now we move to item 7.5. Public notification to classify existing reserves within the Golden Bay ward. And I note, Councillor Butler, you're still online.
Yes, I'm still online.
Yeah, I meant when I read this report, I thought I should have rung you before this meeting because you're the obvious person to chair this. So I just want to ask you if you're interested in chairing this committee. And my apologies for not ringing you for that.
Oh, that's all right, Chair. Yes, I am. And I've actually been in touch with Councillor Hume, who's not able to be here today, as to whether or not he's willing to go onto the panel. And he has indicated that that he would be, taking into account his requirements of his business. So, yeah. My council computer has actually just died, so it's just completely not responsive. So I'm just here on my PC, so I can't look at the agenda or anything like that, but that's all right. I don't think I need to. I'm familiar with it.
Right, so Anna, over to you. I think it's all on page 35, but we had to nominate 2 councillors to be on this. And I thought it was obvious that the 2 ward councillors and the more experienced councillor would chair it. And also there's the community board chair to sit on this panel as well. But over to you, Anna. My apologies again, Councillor Butler. I did mean to ring you yesterday, but I got sidetracked. It was such a nice day.
Thank you, Chair. Kia ora koutou. I'll be brief and I'll take my report as read. So the purpose is to seek your agreement to publicly notify the proposals to classify existing reserves in Golden Bay ward that have not yet been classified, which is 171 parcels across the ward, to appoint a hearings panel, confirm the consultation dates, and to consider the recommendations from the community board from their meeting from last week. The board had no proposed changes to our proposals that we put forward. But we had a long hui with iwi previously to work through them all and consider cultural values as well, and made several changes from our initial staff proposals based as a result of that hui. So you've already highlighted the changes made to the recommendation 7 there. That was just our suggestion as to how many people, if some other councillors also wish to be on the panel, they're most welcome to. But we're recommending at least 2 councillors, the chair of the board, and up to 2 Mātauranga Māori experts to be appointed by the mayor. This is something we've done with all previous ward reserve classifications. That's worked well. I'm happy to take questions. Thank you.
Councillor Butler, do you have any questions other than having sat on one of these? They're a lot of work. There is and I know some other councillors around the table. So we just want to make sure that Councillor Hume is able to manage the workload. You understand what it is. Will he be able to manage the workload?
Well,
or she's spoken to him.
Yes, so I'm just not sure what our options are at the moment. I mean, I have had a reply from him saying yes, but he won't know what the workload is. And I suppose we can just appoint him and and go with that. And if there's a problem, then we might have to revisit the membership of the panel, or we could put a deputy person, a third person in as a backup. That would mean just a change to the resolution. A third person. I'm just not sure what you've done in the past with this.
I think in the past we've had wording that allows a councillor to be co-opted if someone is unavailable.
Yep.
If I remember rightly, Anna. But it is quite a bit of work, and the hearings I would expect to be in Golden Bay.
Right. Well, given that, sorry to keep on situation, I would propose an amendment that would include a deputy. I'm just not sure about the wording there, but I would like to just put that amendment to the resolution to have a backup.
I don't think it's a deputy. It's a point you can appoint. Yeah, that the mayor could appoint an additional councillor if required to fill it. We'll look at some wording, just that. While we're doing this, Councillor Greeny's got a question about this. Councillor Green, did you have a question?
In the past, we have regularly added a clause which doesn't seem to be present, where if someone's not available, then the chair usually taps up someone else. And it's pretty standard wording that we've used on many other occasions for this.
That's what I was thinking, but I'm not sure that governance has got it.
So it is surprising it's not there, because we have regularly insisted that we have this backup clause.
Yeah.
Yeah, apologies for that.
So I'm sure you can grab it from somewhere else, and it just needs to be inserted.
Yep, they're doing that right now. So we'll just hold fire for a couple of seconds. Delegates authority to the chair to appoint another panel member. Do you mean the chair of this committee or the chair of this? I'm pretty relaxed. I think the chair to appoint another member if one panel member should be unavailable. That seems to cover it.
Yep.
Councillor Ellis.
Do we need to specify that it's an elected member at all?
So it's councillors we're doing. So
Yeah, there should be standard wording that we've used in the past. It should just be a grab drop.
yeah, well, they don't need to have it, but anyway, we've got something up on the board that looks fine now. So any other questions of Anna in relation to this? Councillor Kittermont, are you?
Thank you, through the chair. Thank you, Anna, for this, and good luck with sorting this lot out. I can see a whole host of fish hooks in here. I think I need more help understanding local purpose esplanades, Maori cultural values in Esplanade. So we're going to designate some areas that are already Esplanade reserves into a local purpose Maori cultural reserves and Esplanade. But we must recognise the cultural values in the future management. Is the word must there, or is it should be another word that is less directive of what we must be doing? Because I'm wondering, whilst we have to respect the Maori culture and all the rest of it, I think the word must be recognised as probably going a step that says this is in law, into bylaws, that sort of thing. So I'm wondering, are we opening ourselves up for a challenge? That's my question. Are we able to do that?
Through the chair. So the point of classifying a reserve is so that everyone understands what the purpose of that reserve is. But when you then go on to notify your draft reserve management plan, and the text relating to that particular reserve needs to reflect the purpose for which it's been classified. So, for example, a scenic reserve, if someone had the idea of putting a casino on it, that wouldn't really be appropriate because the casino is not something that you'd usually see on something that's been protected for its high scenic and natural and cultural values. So it's just setting out clearly what the reserve is to be managed for. And in the case of Golden Bay and through our Hauwere, we discovered there's a rich cultural layer along the entire coastline, which they felt strongly needs to be reflected in the purpose of the reserve. That's not actually their ideal classification. There's nothing, because the Reserves Act is so old, from 1977, doesn't really reflect things adequately. But that was a compromise they came to, because local purpose reserves are the most flexible in terms of the description. You can describe the bit in brackets, which is Māori cultural values and esplanade, within there, and there's no like, apart from historic reserve, there's no other status that clearly identifies where those values are.
So it's a defendable position. We're fine. I'm happy with that, because there might be koiwi there or middens, so to speak. Okay, cool. Thank you.
All right. So we've amended the motion to delegate authority to the panel chair to appoint another member if somebody, if one of the two elected members are unavailable. Someone happy to move that? Councillor Ellis, and seconded Councillor Kinamont. Any other discussion? None. I'll put the motion. All those in favour, please say aye.
Aye.
Against? Carried. I think that brings us to the conclusion of our meeting today, and I'll ask Sue to close with karakia.
Kia ora. Kia hiki, te kōrero, kia wātia, kia mama, te manawa o te tangata. Kia utu, ki te ara mō tātou I ora nai, ki rono, ki runga, ki a